All right, hey, what's going on, everybody? It's Cody, and I've been asked this question quite a few times, so I thought I'd make this little video on debit spreads versus credit spreads. And honestly, you can kind of tweak them to work the same way, regardless of what it is. And I'll show you what I mean with that. And all it does is take a little bit of playing around with the risk graph, but I'll show examples of that. So first, we'll go ahead and just the terminology. Like you'll hear people saying bear put spread or bear call, bull, bull put, things of that nature. So basically, they're all verticals because these are positions you do for an up or down move, right? So basically, all you need to think about is if anything is a bear or something, so that means you're wanting direction to go down. And if it's a put, so bear put means they are bearish the position and they used puts. And then if you already know that puts are for a down move, then it's a debit spread. And the same thing if they say it's a bear call, then you know it's a down move, but they're using calls, so it must be a credit spread because you know calls are for the upside. And it's the exact same thing, just reverse on the bullish side as well. So bull call, bull put, same thing. So it's a very quick little thing. I wanted to clear that up because I've had people message me asking me questions about if what is a debit spread, what is a credit spread, because people are used to just hearing call debit spread or call credit spread. And I've always, when I was learning how to trade and everything was done in this terminology. So that's kind of just what stuck with me. And so that's why I use those words. All right, so what are they? So a debit spread is when you buy in the money, at the money, or out of the money. Call or put, depending on your desired direction. And then you sell an out of the money call or put with the same expiration as your long option. And to get that position, that is when you get in for a debit. A debit meaning you paid to get into that position. So for an example, say it's a 20-25 bull call spread, right? So bull meaning bullish, call meaning use calls. So if it's a 20-25 and say I entered the position for $2, that means I spent, I guess I should be writing this too, huh? That means I spent $2, I paid $2 to make a max profit of $3. And the reason that is how it's $3 is because it's a $5 Y spread, right? And then you paid $2, so that means you have a max profit of $3. So that's what a debit spread is. And then a credit spread is slightly the same, but not really. If that makes any sense. So you sell an in the money, at the money, or out of the money call or put. Basically, I guess I should say this too. It's in the opposite direction of what option you're using. I guess I should put that in there. So like if you're bullish, if you're wanting price to go up, you're going to be doing puts because those are for going down, right? And then if you're bearish, you're going to be using calls. So this is in the opposite option you would normally use. So you sell in the money, at the money, out of the money call or put. Then you buy an out of the money call or put with the same expiration as a short option. And then for this one, you're filled with a credit. So how is it a credit? So in that same example, we'll say it's a $5 wide strike, right? $5 wide. You entered the position for $2. So that means in this case, your max profit is $2. And then your max loss is $3 because your profits are capped by what you're paid. So in that case, it'd be the $2. And you are paid for that position, and you want premium decay, either being implied volatility, theta, delta if it's moving in the right direction. You want the price of the options to decrease because you can cover the short for less money than what you entered it, than what you're paid, and you keep the difference. Just like shorting a stock. So I hope that makes sense. If not, please write your questions below, and I will definitely answer them. I spent a lot of time on this slide, even though it's very short, trying to figure out the best way to articulate it in words, but it's easier to say than write, if that makes any sense. So these slides are really short, but I'm hoping to clear up a lot of it whenever I'll pull up the platform, and I'll just go over it. So, like I said earlier, which ones do you choose? And there are specific differences. So the debit spread, like it says right there, if you're wanting a more directional move, meaning you're expecting the price to move quite a bit, and then you could also still get a better risk reward. Now, a credit spread, on the other hand, you could still be profitable with it moving sideways or the directional move you're looking for, because you paid for it, or you're paid for it, and then you're wanting the price to decrease. Now, like it says right here, depending on the strike price that was sold, you can tweak your risk to reward profile and probability, meaning like there are some people that sell out of the money credit spreads. Say it's there's some people that sell a $5 wide spread, and they're happy with taking only a $1.30 a credit. So that means their max profit is $1.30, but their max loss is $3.70. Some people trade that way for a higher probability, but they still have like stop loss levels. That is something to one way some people trade. So that is what I mean by you can tweak your risk reward, because the more you go at the money, in the money, your risk reward gets better, which is what profile does. And I'll make sure all that makes sense, like I said, in the profile. So basically, debit spreads, you get, if you do them how everyone else does them, like typically a lot of people do delta 70, delta 30s, or delta 60, delta 30 verticals. As of right now, I'm kind of just doing delta 60, delta 30s as my default, and then I'm using my weekly wires indicator if I need to tweak it. And since I'm just talking about that real quick, I'll just go over that. Basically, just since I mentioned weekly wires, this is what this is. Basically, up here, like it says H1, right here is what I'm looking for, is touching. So this tells me that there is a 52% of it touching H1, which is right there in a 2-week time frame. But that was starting on this day, so that is no longer valid. On Monday, where it opens, a new set of lines will appear. So anyways, that's basically what I'm saying, is I would sell that strike as my target versus a delta 30 option or call. All right, so like I said, you can take advantage of a bigger delta move on debit spreads for a better risk to reward. Credit spreads have higher probability, but offer a lower risk to reward. And then with credit spreads, you also need a lot more theta decay or premium decay for quicker profits anyways. Like if the move happens really fast, your profits won't be as good because you still need the premium decay of your short strike. Things to consider whenever you're choosing one. And so this kind of goes to how you decide which option to do it with. So one side calls or puts have inflated option prices. This is usually due to implied volatility increasing, and if that is the case, then usually you can get a better risk reward profile with a credit spread because implied volatility is higher. Only on one side. Open interest. So there has been times where if I'm trading a thinner stock where I want to do a bullish play, but I want to do a credit spread because I want to not aim as far out. I could use calls, but still organize it or construct it in such a way that it's like a credit spread, and I'll go over examples. And then another thing to consider is target or time till your target is hit. So you get your most profit whenever a lot of your premium decays on your short strike. So say I entered a 30-day vertical like that, we'll see that 20-25 bull call spread, and it's 30 days out, but it gets to 25 the next day. My profit is going to be significantly less because I need the premium decay of the short strike. So whenever credit spreads tend to decrease a lot faster, especially when implied volatility starts decreasing, but those are just things to think about. All right, so now that everyone is confused, I'm going to go ahead and try explaining it. Okay, so go ahead and do this, and all right, here's SunPower, stock I'm looking for this week. All right, so we'll just say, let me move this over here. We're going to target the 55 level, right? So, and it's right about 45, which would be slightly out of the money bull call spread. We do in the money at the 40, and I'll show you what we do. So the main thing right now that I'm talking about is let's focus on, we're targeting 55. All right, and I pre-put this together, so I'm not just fumbling around in the middle of this. So we can go over here and say we'll say in 11 days we're targeting 55. So you can go to 55, and this is a bull call spread. Actually, we'll go ahead and erase this so you can see them form. Okay, so 55, we'll sell the 55, and we'll go, and if you don't know, so this is my delta column. We're going to buy, we'll go with the delta 60s, which are the 43s. So 43 and edit, boom. All right, so it put it down here. So you see I have a 43.55 bull call spread for $3.37 is what it says right now I could get it for. Now what does that look like? All right, here is a risk graph. And I'll do a quick review of this. Okay, so it's just like a graph. Right here is your potential risk to reward. Right here is your break-even line. Down here is stock price. And I'll change colors. All right, this blue line, bluish line, that is your profit loss at expiration. And I'll clear this up real quick. And then this purplish line is your risk to reward for the current day. And then your break-even line for today is that line, and then break-even at expiration is that line. So, if that makes since it's honestly really easy the more you mess with it. So right now, current stock price is right here. And our max profit is right on line, which is, and if you didn't know, this gray line right here, that is a 1 standard deviation. So that's where the bell curve is. So that says there's a 68% chance that it'll hit that level. Or be within that range anyways. All right, so what to cover on this? So, all right, so let's go ahead and make this at a 1 contract or 1 position rating. So what I want you to do is put your attention on this box. As I move the mouse, it shows your risk to reward per stock price down here. So if you see over here, max loss would be $337 for a max profit of $863. Now my break even at expiration is $46.39, and you get that at the bottom of this line. Like look right here whenever I put the mouse there. See right there. Or I guess it's 44.50-ish. So anyways, you can see that you need to move just a little bit from here to there to be a break even at expiration. But so your break even's close, and your risk to reward is slightly more than 2 to 1 because you see your max loss is 337 for a max profit of 863. Now, what about a debit spread or a credit spread? If we were to target, once again, 55. And then I sold the 43, or bought the 43. All right, so this is what I'm talking about, where they could be pretty much identical. So like I'll decrease this one. It looks pretty much the same at a one contract level. Max loss is 360, max profit 840. And so the risk profile is the same. You need the same amount of directional move and everything to get there. But here's where it's different. And so I'll show you where it's different. So we'll do the delta 60s, like I said, so which would be the 43s. Sell the delta 30s. So we have 31, 28. Which one do I want? We'll go 31. Which that in that case is a 43.53. Now, and I'll show you why this is important. So now your risk to reward is 280 to 719, and the reason that changes, honestly, is because just the sold strike. We brought it down $2, so therefore the max profit is decreased because your profit is capped at your short strike. Now, where it changes, and this is where credit spreads are pretty cool. We'll go and see delta 6. We have a lot of delta 60s. All right. Which one has the most volume? All right, 51s. Or open interest, anyways. And delta 30 is the 40s. Whoa, what happened there? Oh, messed up. And if you didn't know, instead of having doing all the clicking, like where people go like this, and they create this, that type of thing, if you already know what you want, so, and also I didn't point out, this is my delta column, if you didn't already see. But, so, delta 60, and we said the one with the most, we'll go 50s, just because they have more open interest, sorry. There, and 43, sorry, 40. You can hold down control and click, and it brings it up, and then it puts it all together without having to do all the clicking. So in this case, we did the exact same thing at delta 60, delta 30. You can see that it doesn't, it can move sideways to up and you'd be profitable. And the difference here is, let's look at it from a one contract position. You could risk 410 to make 590. So you could have 100% return and have a high probability of it. And then what I was going to show you was if, let me clear this up real quick. All right, so say you're one of the guys or people that like this out of the money credit spreads, which is completely okay. Say you want to sell below that support, which is, we'll say, is 40. And this is how you can make a call debit spread look the exact same way. So let's clear that up. And all you got to do is you can play with this risk graph and you can find out a bunch of things. So if we're going to sell that out of the money, we'll say 40, 48. So that's $2 and you get 68 cents. So in this case, you can see how the stock price is up here. So it can move. It has a lot of wiggle room to the downside before you start having a loss. So you could risk a max loss of 132 to make 68. Now, how can I make a bull call spread or a call debit spread look the same? So this is how you could do it. All right, here's the theta column. And so whenever you buy one of these strikes, that's how much theta you have. That's decreasing from it every day. Now, the deeper in the money you go, you see it, the more it decreases. So you can increase your delta on the option you're buying. So we'll just use this as we'll say 40, which has a delta of 14. All right. So now we'll go down to, we'll say 44.50, which has a delta of 19. So that means we're actually going to have theta positive because your theta was actually be 5 cents. And you see it's a debit spread for 210. And it looks about the same. It is a debit spread, and with credit spreads, your probability of it being exercised is increased with a debit spread. Oops, actually, let me increase that one. Okay. So in this case, it's already at your max profit level. So all it has to do is not go down to, let's see what level that is. Uh, 42. So as long as it doesn't go down to 42, you'll be profitable. And from a one contract basis, you're risking 210 to make 240. So you still could make 100% return if it was to move sideways to up on a bull call spread where it's still theta positive. So if you get in the risk graph, you could just tweak it and work the Greeks to your favor. It doesn't always have to be like only credit spreads are theta positive. Well, that's not right. You can still tweak a debit spread to be theta positive. You just have to know what to look for. And so I hope that really clears that up. Like I've been trying to get this video for a while, but it's really hard to articulate. It's something you just kind of have to really experience. But I hope this does clear it up some. If you have any questions, please write them in the comments section below. And I will definitely answer them. If you found this video helpful, like, subscribe. You know the whole YouTube shindig every person says at the end of their video. But yeah, thank you very much for watching. And there are a ton of other YouTube videos out there to give descriptions on verticals, credit spreads, and debit spreads, but they never really go into how you could tweak them to your favor, like this video did. And I hope it does, like I said, clear it up. But yeah, anyways, thank you very much, and take care.